Okay, welcome to part 4, AMM market making. Nathan, take it away. So, really, we got to look at the empirical methodology and the results. In this section, we examine the impact of technology upgrades in London Stock Exchange, high-frequency trading activities and execution costs of institutional investors separately. We present figures of high-frequency trading and execution costs around the technology changing events, and we also run panel regressions to examine the effect. Finally, to assess the link between high-frequency trading and institutional investors' execution cost, we implement a two-stage least squares regression though we caution that there are assumptions underpinning this technique which may not hold. The technology exchange latency changes. The technological upgrades we base our analysis on are latency changes by the London Stock Exchange. Given that the changes in the network speeds are in milliseconds, the changes will only have direct impact on computer-based trading. Non-high-frequency trading algorithmic traders may be marginally impacted by millisecond latency changes, but arguably those who depend most on speed, high-frequency traders, are the most likely to be affected. In addition, while high-frequency trading may lobby the exchange to increase its latency, high-frequency traders do not determine exactly when such changes are implemented. As a result, network latency may provide a reasonable shock to the high-frequency trading activity while having little direct impact on trading activities of institutional investors. Wagner, Kurdich, and the like, Henman, follow a similar approach. Since 2007, there have been a variety of technology changes at the London Stock Exchange reducing latency. From 2011 annual report of the London Stock Exchange, we collect a list of 5 technology upgrades during the sample that decreased the latency of the fastest traders from 11 milliseconds down to 0.113 milliseconds. This upgrade includes the major changes of the trade elect system and the introduction of the Millennium system. There you go. So that all sounds quite important. I mean, to us, with Stellar, this is important. What you got to think about is actually, high frequency trading and, getting your orders in before anybody else to affect your strategy. Because if you're at the front, you're affecting your strategy first, then you're going to reap the benefits. And that might only be the difference between sort of 0.5%. But when you're working with vast scales of money, that's a huge amount of money. That's your profit margin. So I read on. We studied the implementation of Trade Elect 3 to 5. Originally, the research design called for use of all 5 latency improvements during the sample. However, due to data limitation and market conditions, we are limited to the Trade Elect 3 to 5 upgrades. The Trade Elect 2 implementation occurs prior to our dataset and gives us baseline latency at the onset of our sample. The Millennium implementation occurs during a time in which the fraction of high-frequency trading activities captured in the FSA dataset has declined, and the measure may not accurately capture changing in the high-frequency activity. However, there are issues with Elect 3 and 4.1 as well. Elect 3 occurred shortly after Lehman collapsed, and Elect 4.1 occurred only a few weeks after trading Elect 4. There you go. To analyze the impact of technology change in high-frequency trading activities and long-term investors' execution costs, we examine trading around the technology changes events. We graphically compare the levels of the daily average of the high-frequency trading activity measured for the FTSE top 250 before and after the latency upgrade implementation change. We pilot the time series for 20-day window, 10 days before and 10 days after latency change. We use a narrow window to isolate the possible effect of latency changes from other effects due to prevalent market conditions. We then conduct the same analysis for execution cost time series. Shows the graph results at a similar 40-day window. Look, you're going to have to read through this because there's going to be some figures in here. It's well worth a read to get a good understanding of the way this high frequency trading can affect and how you can get ahead of the curve. But I really just want to jump to the conclusion because this is taking up quite a bit of time. There's quite a lot of charts to go through. So really, if I can find where they've concluded. So let's go for looking forward. What does the future hold for high frequency trading, financial markets and institutional investors? Of course, there is a great deal of uncertainty as to how markets and market participants will evolve over the next 10 years. However, we try to provide some insight into possible developments in the future. Execution blockchain, you didn't see that one coming. Execution costs are comprised of bid-ask spread commissions and clearing settlement costs. These reflect our direct costs such as human capital and infrastructure. Evidence in the Foresight Drive review indicates that the advent of high frequency trading has coincided with a decline in bid-ask spreads and commission. It is possible execution costs in 10 years could continue to decrease for a variety of reasons. First, new entries may trigger price wars that end up with further deductions in clearing fees, and it was the case when Xlm operations in the Dutch market, Frederick and Payne. Second, advances in technology such as one described in Cliff Brown and Trelevan might imply lower transaction costs. So, yeah. The primary impact of cloud computing on activities in financial markets in the next 10 years will not be in the provision of computing facilities that automate execution, but rather in the ability of the cloud to provide cheaper, elastically scalable, high-performance computing, HPC. The convergence of cheaper computer power, statistically sophisticated and computationally intensive trading strategies, fast automated execution via STP and DMA means that in the last 2 or 3 years it has become commonplace for market participants to seek counterparties to a transaction electronically identify a counterparty and then execute the trade all within a small number of seconds. Interesting. These changes in technology might lower barriers to entry. Additionally, market players could appear in the sector which may offer lower commissions than those that currently exist. Moreover, new market players established in countries with lower operating costs could offer the same level of service at a lower price. In addition, new regulations fostering competition could increase competition for volume on a global scale, with a potential reduction of commissions charged by exchanges as more and more participants enter the market and compete for volume. On the other hand, there are factors that may increase execution costs in the future. First, new forms of manipulation such as algorithms programmed to take advantage of other algorithms can rise trading costs and move prices away from the efficient levels. That's again Linton O'Hara. Also, as observed in Menkveld, high frequency traders overinvest in technology relative to a social optimum if the main motivation is to be ahead of rival high frequency traders when trading on a publicly observed signal. Some advances in technology, for example, silicon encrypted algorithms and adaptive algorithms, might lead to a costly race to acquire the largest technology. And I like that. I mean, you got this. That's an app idea. Liquidity wars. So we have like guys providing, stellar-based AMM all at war together. Like, I'm going to gamify it. That's an app idea for me. just sprung out of this. And there you go. We'll have to stop that there. Again, video getting a little bit too long. See you on the other side. Part 5, market making. See you there.